In this video, I'm going to show you what a market maker sell model is and what a market maker buy model is. The first thing in the market maker sell model is the smart money reversal. And the smart money reversal is the movement that reverses price. This smart money reversal often happens whenever we touch any form of PD array. So let's say we have a bearish fair value gap over here, and then we touch this bearish fair value gap, then we should reverse in price. I also look for a SMT whenever we have a smart money reversal. And in one of my recent videos, I talked about what a SMT is. So let's say whenever on this P500, let's say this PD array is buy side liquidity. So on the S&P 500, we take out this buy side liquidity, but on the Nasdaq, we fail to take out this buy side liquidity. So then I could be expecting a reversal. So when we start to reverse from the smart money reversal, we want to see if there's any fair value gap that forms in this range. The first fair value gap that forms in the smart money reversal is called a low risk buy fair value gap. And the reason it's called low risk buy is because let's say you were to take a trade entry right here at the start of the fair value gap, and then you will put your stop loss at the smart money reversal. And there's not a lot of risk putting your stop loss at the smart money reversal because you could be making a good risk reward. Whenever we start going lower from the low risk buy fair value gap, and let's say we make a shift in market structure, taking out this sell side liquidity, we want to see a fair value gap forming. And this fair value gap, it could be used as a trade entry, and that trade entry will be called the first stage distribution. And the first stage distribution is the first movement to the upside after the low risk buy. The first stage distribution fair value gap is also a great trade entry because we have made a shift in market structure. And that shift in market structure means the trend is on our side. And whenever the trend is on our side, there's a higher probability for the trade working. If you wanted to take a trade entry at the first stage distribution fair value gap, it would look something like this. So your entry would be right at the low of this fair value gap, and then your stop loss would be at the high we formed at the low risk buy fair value gap. The reason you want to put your stop loss above the high we formed at the low risk buy fair value gap is because it's called an intermediate high. And that's basically a high that we shouldn't retrace up to before we touch the original consolidation. Now that we know what the first stage distribution is, we can go down into the second stage distribution. The second stage distribution is formed in the down movement from the first stage distribution. So in this down movement, we want to find any form of PD array. In this example, I'm going to use a fair value gap. The second stage distribution is probably the highest probability trade entry that you could be taking, in my opinion, because we already have made a lot of bearish momentum and we know that the trend is on our side and we shouldn't make a retracement before we have touched the original consolidation. A quick thing that I want to add to your notes is on the sell side, it's called distribution, and on the buy side, it's called accumulation. So instead of first stage distribution, on the buy side, it's called first stage accumulation. You can also use standard deviations to anticipate where price should be going. And there's two different places that you want to use standard deviations on. The first place you want to use standard deviations is the move up to the smart money reversal. And these standard deviations should be aligning with the original consolidation at the -2 to -2.5 range. You can also be anticipating a first stage distribution or a second stage distribution at the -1 to -1.5 range. So let's say the -1 to -1.5 range aligns with the first stage distribution, Then we tap down into the -1 to -1.5 range, and then we should go up to, let's say, a fair value gap, and then go down and be targeting the -2 to -2.5 range. I messed a little bit up on the smart money reversal. I made it a little bit too big, but right here you can see how it will look like if the smart money reversal standard deviations would be aligning with the first stage distribution. So as you see right here at the -1 to -1.5 range, we get a manipulation move to the upside to the fair value gap, and then get a distribution down to the -2 to -2.5 range. The second place you want to use standard deviations is the move up to the low risk buy fair value gap. And as you see, the -1 to -1.5 range aligns with the first stage distribution, and the original consolidation aligns with the -2 to -2.5 range. Also, something that you want to add to your notes is whenever we make the move down from the smart money reversal, see right here, we always need to be forming a fair value gap. If you don't form a fair value gap, we couldn't be anticipating a market maker sell model. Whenever you take a trade entry off of any of these three areas, you always want to be targeting the original consolidation, because whenever we touch the original consolidation, we could no longer be expecting price respecting these three areas. Another thing that you want to take notes of is upside candles in this market maker sell model will act as support to go lower until the original consolidation, and I will go in details in what this means later. When there's any form of PD array that support price to go higher on the buy side of the curve, you could be expecting those PD arrays to support price go lower on the sell side of the curve, and I will also go in details in what this means later. It's always important to notice the fair value gaps we form in the market maker sell model, because they can always be used as first stage distribution or second stage distribution. And you also always want to see a reaction off of those fair value gaps. A market maker buy model is almost the exact same as a market maker sell model. The only difference is a market maker buy model is the buy side of the curve, and as I said before, the market maker sell model is the sell side of the curve. The concepts on the market maker sell model also work on the market maker buy model. So as you see, we have the PD array that made the smart money reversal, then we have the low risk buy fair value gap, and then instead of distribution, we have the first stage accumulation fair value gap, and then the second stage accumulation fair value gap. And we also want to be targeting the original consolidation on the buy side of the curve. The standard deviations also work on the market maker buy model. As you see, at the -1 to -1.5 range aligns with the second stage accumulation, and the original consolidation aligns with the -2 to -2.5 range. The low risk buy standard deviations also work, of course, on the market maker buy model, and as you see at the -1 to -1.5 range, we have the first stage accumulation. So now that we know what a market maker buy model is and what a market maker sell model is, we can go into the charts and find some examples. The first example I'm going to show you is a market maker buy model, and right here we have touched a 4-hour fair value gap. So now we could be anticipating a smart money reversal. So right here we form a fair value gap, and this fair value gap could be used as your low risk buy. Right here we touch the fair value gap, so a trade entry will look something like this, where your stop loss would be at the smart money reversal, and then you can zoom out and find any original consolidation right here. This may not look like a original consolidation, but if you go out on the 1 hour and zoom out, you can see it a bit more clear. Now let's see what happens at the low risk buy. So right here we touch through the fair value gap, and it's important to notice that we don't close below the fair value gap because that means it's inversed. But right here you see we get a strong reaction to the upside. So now whenever we take out these highs right here and make a market structure shift, we could be expecting a reaccumulation or first stage accumulation. So right here we formed the high. So now we could use the discount to find the fair value gap you want to use. So right here we have a fair value gap in a discount. So if you were to take a trade entry at this fair value gap, then you want to put your stop loss at the low of this low we created at the low risk buy and target the low of the consolidation, but that doesn't create a 2 risk reward ratio. So then you could just be targeting 2 risk reward ratio. So now let's see what happens. So right here we touch the fair value gap, and it's important that we don't close below the fair value gap. We end up taking out this high, so let's see if we can also get the 2 risk reward ratio. And we end up getting the 2 risk reward ratio. It's important to notice that all the downclose candle act as support. So as you see right here, we have a downclose candle, then we touch this downclose candle and go higher, and the same with right here. And then this huge set of downclose candles also act as support. We also want to use standard deviations. So right here we have to move down to smart mode reversal, so that would be the standard deviation we would use. And as you see, the -1 to -1.5 aligns with the reaccumulation. And right here we used the standard deviation on the low risk buy move, and the -1 to -1.5 aligns right here. So this would be our second stage accumulation. The standard deviations also aligns with the original consolidation. So the smart money reversal standard deviations align with the low of the original consolidation, as you see the -2 to -2.5, and the low risk buy standard deviations align with the high of the original consolidation at the -2 to -2.5 range. Now I'm going to show a market maker sell model, but I'm not going to go so much in details because everything on the market maker buy model you can use on the market maker sell model. So right here we made a SMT on the Nasdaq, so that means we took out these highs on the Nasdaq but failed on the S&P 500. So now we could expect a reversal. That means this is our smart money reversal. And also, as I said before, it's important that we use the standard deviations up to the smart money reversal. Right here we form our low risk buy fair value gap. And something that you want to add to your notes, we don't need to touch the fair value gap just as long as we create it. Right here we touch the -1 to -1.5 range of the standard deviations, so now we could expect a first stage distribution up to this fair value gap. And if you would like to take a trade entry at this fair value gap, you could enter at the bottom of the fair value gap and target the -2 to -2.5 range. Also, we didn't form a high up to the low risk buy fair value gap, so then you could put your stop loss at the high of the fair value gap. And this also creates a 3.14 risk reward ratio. So right here we touched the fair value gap and we didn't touch the high, so now we could anticipate price going down to the -2 to -2.5 range. And right here we touch it. This video was all about market maker models and how you can use them. So if you like this video, please like and subscribe. And if there's anything you didn't understand, just comment down below.